Warren Buffett recommends that investors invest 90% of their money in an S&P 500 fund and the remaining 10% in short-term government bonds. This is an excellent method for many investors who like to keep things easy by investing on autopilot rather than analyzing their portfolios on a daily basis. One noteworthy drawback of this technique is that you are restricted to just investing in major U.S. corporations. By investing in a variety of Vanguard funds, you may enhance your visibility to other markets while retaining your portfolio simple. There are other ETF or exchange-traded funds available through index fund firms, but Vanguard has long been the preferred option for many investors. Fees at long-established investment businesses are incredibly competitive, allowing you to invest for as little as possible while yet receiving a good return on your retirement savings. The company was formed in 1975 by John Bogle, who is widely regarded as the father of index funds. Other firms provide funds that are fairly similar. You're free to choose the company of your choice, but to keep things simple, we'll just focus on Vanguard funds. The first and most popular fund is VOO, which is Vanguard's S&P 500 ETF, and it is very prominent. The S&P 500 index includes the 500 largest U.S. firms. This index is frequently seen as a reliable measure of the overall market's performance. When individuals refer to the market, this is usually what they're referring to. Some of the criteria the stock must meet in order for a company to be selected for this index is that it must be a U.S.-based company. The market cap of the company must be at least $5.3 billion or more. The company's earnings must have been positive over the previous 4 quarters, and the stock must be selling at an acceptable per-share price. These are some of the reasons why Warren Buffett suggests the fund to most investors. A few names included in the fund are Apple, Microsoft, Exxon, and Johnson & Johnson. The expense ratio of the fund is approximately 0.03%, making it one of the most cost-effective investments available. VOAM is a high-dividend yield exchange-traded fund that is largely focused on investing in firms that consistently pay out dividends or make payments to shareholders. Trading equities with high dividend yields and little risk is the focus of this strategy. It is made up of 425 companies, the majority of which are significant U.S. corporations. Due to the fact that consumer goods, financial services, and healthcare are the 3 most important sectors, growth in these 3 areas tends to be a little slower than the overall market. This is an excellent investment for retirees who are able to live off their dividend payments, not requiring them to sell their investments for income. Verizon, Chevron, and AT&T are among the fund's major holdings. With an expense ratio of 0.06%, the fund is higher priced than the S&P 500 ETF. VTI, or Vanguard Total Stock Market ETF, is a vehicle that tries to imitate the performance of the whole stock market rather than just large businesses like the S&P 500 does. Owning shares in over 3,600 different firms, the fund invests in stocks that are widely diversified from tiny to major corporations are all advantages of being a member of the fund invests. VTI invests in a diverse variety of equities, enabling it to benefit from the returns generated by a diverse number of companies rather than only the biggest in the country. Included among the top 10 holdings are Alphabet, Exxon, Apple, and JP Chase. Technology, financial services, and healthcare are the 3 major sectors. The expense ratio is extremely low, averaging only 0.04% per year. VUG, often known as the Vanguard Growth ETF, is a mutual fund that is highly reliant on investing in firms that have a tendency to expand in capital or grow in size. The fund carries large-cap firms such as Apple, Amazon, Facebook, and Google, and it has over 300 different stocks in total. Even if they share in the earnings, huge growth companies like those described are more volatile and sensitive to market changes, making them more appealing to younger investors with a higher risk tolerance than smaller growth companies. This is a well-balanced fund for individuals ready to take on slightly more risk, with technology being its single largest sector, followed by consumer services and industrials. With an expense ratio of 0.04%, it is competitive with other Vanguard funds in terms of cost. VT, the Vanguard Total World Stock Fund, is a great way to gain exposure to global stocks comprised of U.S. and foreign companies. The fund has shares in approximately 8,000 different firms ranging in size from micro to large, with the majority of the fund invested in U.S. stocks and a worldwide market mix. With holdings in firms such as Facebook, Berkshire Hathaway, and Exxon, this fund is an excellent method for investors to diversify their portfolios and avoid becoming too focused in the U.S. With an expense ratio of 0.09%, the fund is slightly more expensive than the others but still very reasonable. These were the 5 most popular Vanguard funds. If this video was helpful, don't forget to like and subscribe. Hit that bell to never miss out when I upload a new video. See you next time.